Everyone's talking about valuations and markets trading at crazy prices, but today we'll be talking to our fund managers about the business they would own if the market crashed or if it traded at a cheaper price.
One stock that I picked last year, which I think go with again, is it's comfortably the best stock on the Australian market. And what I really like about it now is it's got international optionality that probably wasn't there, and that's REA. We owned it in the period when it got sold off in the COVID collapse last year. For once, this question came about where you actually got to buy something at a price a lot cheaper. But what I really like about it, everyone knows the platform in Australia, everyone knows that it produces stunning returns and it dominates that market with Domain, a second terrific market structure. But what it's got is it's got a shareholding with News Corp, which it's our own biggest shareholder in a group called Move in the US. Everyone knows Zillow, but Move is a platform for residential real estate transactions, just like REA has here, realestate.com, and it's in the US. And it's probably 10 years behind what we have here. So I think there's great optionality that people don't realise that in time they'll probably buy that off News and own it outright.
I guess a stock that we absolutely love, and if we had an opportunity to buy it at a lower price, we'd definitely be piling in, and that company is Serko. So I don't know if you've come across Serko. It's basically a corporate travel technology company, and they're a market leader in Australia and New Zealand. They've got really big deals with Flight Centre, and other big corporate travel management players, which is why their brand isn't kind of front-facing with consumers. But Serko's just done the most incredible deal with Booking.com. Booking.com scoured the globe looking for the best corporate travel tech platform. They landed on Serko, so that was a big tick. But the really outstanding thing about this deal is Booking.com has agreed to share 50% of their revenue from building a corporate travel business in Europe with Serko, and Booking.com's one of the best known brands globally. They've already built quite a sizable SME travel business in Europe, so it's a huge opportunity for Serko, and we're really expecting the company to execute on that over the next 12 to 18 months. But if it was to trade down further, we'd pile in again.
Well, it's got to be realestate.com. It's the old rivers of gold. You think about the newspapers from years ago, they talked about the classifieds being the rivers of gold. The whole dynamic of the way people advertise for real estate now has changed, and it's a quasi-monopoly. If you're selling your house, you have to advertise on it. They've got incredible pricing power. We've seen historically the earnings of these sort of businesses only going one way over time. So if you get a chance to buy it cheaply because the market's had a meltdown, it's a great stock to buy.
Look, I'll give you one that's already fallen a long way, so it's getting closer, and that's DocuSign. It might be a name familiar to anyone who's working in the corporate world because it's being embedded in more and more companies. I love the business. I think it's got perfect network effects in terms of the more people that are using it, the more valuable the product becomes. They've been a huge COVID beneficiary, signed up hundreds and thousands of clients. That is slowing because COVID is ending, and the share price was down 40% last Thursday. Another 40% would be nice, but it's a business that I really like to own.
I've got a caveat here because every crash is different. In March 2020, the things which were retail cyclicals just fell through the floor, and we loaded up on things like AP Eagers, Premier Investments, Event Hospitality. We loaded up on these, and they're great opportunities. The thing I like doing in these sort of environments is finding where the stress is most acute and finding the best company in that space. But in essence of answering your question, if everything was to fall the same, a company like Xero is something which is too expensive for me now, but I think it's a wonderful business, well managed.
Yes, I've been doing a lot of work on Altium more recently. The business was impacted quite heavily over COVID. A lot of their customers are small, medium-sized businesses, and they were not in a position to be buying that software over the COVID impacted period. It's just starting to recover right now, and I think the market's numbers are actually a little bit undercooked in terms of the upside there. But unfortunately at the moment it's the top end of its valuation range, and looking for a cheaper entry price into that name.
Local tech names are great companies. I mean, realestate.com, Seek are some of the best quality stocks in the Australian market in terms of long-term prospects, and in particularly for REA, low risk profile. It's certainly not on our radar from a valuation perspective now, but if it pulled back by 2/3 or so, we'd certainly love to own it.
I think we'd own every single stock in our portfolio in bigger size if you'd sell it to me more cheaply right now.
Okay, but if you had to name one stock.
But I had no one stock, and,
Okay.
it's a new stock, one that's not in the portfolio.
Okay.
I said it last year, I'll say the same one again, it's Airbnb. So Airbnb, as everybody will obviously know, is the largest platform in the world for alternative accommodation. So connecting hosts that are renting out their place with guests, and as a result of doing that, they've got a massive network effect that can't be broken. And on top of that, the alternative accommodation space is a $1 trillion market opportunity that's less than 5% penetrated today. And we think that short-term stays are going to be supercharged, especially with the shift to remote working that we've seen come out of the back of the pandemic.
100%.
And Airbnb IPO'd, unfortunately, at the end of 2020, and the stock very quickly doubled on the first day of trading. And it's been trading about $160, right around the same level for the last 12 months, which is a little bit too expensive for us. So we're waiting to see if it's going to pull back and give us an opportunity.
We have a very small position in Sherwin-Williams, mainly on valuation, but that's something I'd like to own a lot more of. It's quite a boring industry. It's paints. Who thought paints could be exciting? It's based in Cleveland. It has that amazing Midwest culture. They really focus on customers, obsessed by their customers, really look after their employees. They have a terrific culture. The CEO has been there 36 years, pretty much the only job he's ever had. The average management tenure is 24 years. Their staff turnover, store manager turnover is less than 10%, which is unheralded in retail. They've paid rising dividends for 45 years, and the company's over 160 years old. That's exactly the type of business I love to own, but at the moment we've only got a very small position because the valuation's quite full.